I want to welcome you all here today. Just a quick presentation on why I think you should invest with us, Evergreen. So here at Evergreen, we were founded in 2012 when myself and the founding partners met and decided we wanted to devote our firm to sustainable investing. And since then, we've gone from strength to strength, winning multiple sustainable investment awards in 2017, 2018, and 2019. So today, we're going to be talking about our new investment strategy that caters to clients' needs and wants. Our strategy here involves incorporating environmental and social governance factors into all of our investment funds. There are three ways to invest sustainably: exclusion, integration, and impact. Exclusion is excluding companies or industries from a portfolio. Integrating is integrating environmental and social governance factors into portfolios. And impact is investing with an impact on the world, but also an impact on the account. Client satisfaction is very big for us here, so we hope to bring in more clients. We're always going to keep them happy. Later in the presentation, our CIO, Shani Sebastian, is going to talk about our new algorithmic trading strategy. So I hand you over now to our CIO, Niamh McKenna. He'll talk about the history of the sustainable investments.
Thank you, Robert. The first sustainable mutual fund was launched in 1971 by Pax World and emerged from socially responsible investing. They urged companies to align their investments with their values. Over the past 30 years, sustainable investing has grown exponentially as the awareness of global issues such as global warming have become more apparent and more people are being educated about these issues. Sustainability is the future of investing and can no longer be ignored. With this constantly growing sector, we believe now is the best time for you to invest in sustainability. Our team of financial analysts have picked a strong collection of stocks, bonds, and mutual funds to give you high returns while also being socially conscious. Our CFO, Niall, will now outline the current market outlook.
Thanks, Niamh. I'm Niall, and I'm the Chief Financial Officer here at Evergreen. Let me give you a brief overview of our current market outlook, where we look at some events that could impact on global markets, and more specifically the environmental sector. Firstly, in relation to the pandemic, many vaccines are in the latter stages of development, and we could see a rollout of a viable vaccine by early 2021. In the US, Joe Biden has become US President-elect and has many green policies he wishes to implement, which would be great for the sector. Overall, we believe that there's no better time than now to start investing sustainably. Let me now pass you over to our CMP, Gemma McDowell.
Thank you, Niall. Our hedge fund is composed of 5 different asset types. We have invested in stocks, mutual funds, bonds, green bonds, and ETFs. The portfolio has been diversified across 10 different sectors. This is to reduce the risk exposure of the fund. When choosing what assets to invest in, we looked for 2 things. 1. The company must have an ethos of sustainable investing, and 2. The company must have expected future growth. Renewable energy is the future, and we have chosen to support this by investing sustainably and responsibly. Next Year Energy Partners is one of the 6 stocks we've invested in. We chose this company because of its past performance and forecasted future performance, but also because of its dedication to clean energy. Next Era Energy Partners have a clear strategy for reducing its carbon emissions. From the graph, there's a clear upward trend of growth for the last 5 years, which is a good signal for investors. The Pollen Growth Fund is one of the mutual funds the portfolio has invested in. We chose to invest in this fund because it seeks to invest in companies with a durable earnings profile driven by a sustainable competitive advantage. This falls in line with Evergreen's ethos. The fund also has a 10-year return of 16%, so expected returns will satisfy investors. The BNP Paribas ETF is one of the 6 ETFs we have chosen to invest in. We chose to invest in this ETF because it tracks the performance of the Low Carbon 100 Europe Index. The Low Carbon 100 Europe Index is designed to measure the performance of the 100 largest blue-chip European companies with the lowest CO2 emissions in their sector. The Volksbank is one of the 4 green bonds we've invested in. We chose this bond because of the Volksbank's focus on sustainability and financial resilience. The bond is to make a 1.75% coupon per annum, so it is a source of safe returns for the portfolio. Now handing over to Shanley, the CIO of Evergreen, he'll discuss the performance of the fund and its algorithmic trading.
Thanks, Gemma. So the graph below shows the 5-year performance of the fund. As you can see, the fund has outperformed both the S&P 500 and the Dow Jones Sustainability World Index. So an investment of 10 million 5 years ago would generate a return of 655%. Some of the stats about the 5-year performance. So the annual return is about 36.5%, with a volatility of about 22%. In late 2019, there was a big jump in the value of the fund, and this was due to the COVID-19 pandemic, which saw sustainable investing actually go up. So the return from late 2019 to late 2020 is about 226%. Something new that we're trying to implement into our fund is algorithmic trading. So we backtested a simple algorithm on all the equities in the fund. So the strategy we used was a simple breakout. So we would examine the past highs of a given stock and generate a buy signal as soon as the price of the stock breaks out from its previous high. And after sending out the buy signal, we would also send out a trade stop loss. So as soon as the price of the stock falls to a certain level, the positions will be closed. So this is to ensure that our losses are minimized. So the two pictures below shows the algorithm in action on the Tesla stock for 5 years. So an investment of about 1.6 million 5 years ago into Tesla would accumulate to about 5.8 million. So about a 250% return. In actual fact, the algorithm outperforms the S&P 500. So we did a hypothetical 10 million investment into all the equities in our fund, and using algorithmic trading, the equities accumulate to about 22 million, and while the S&P 500 10 million accumulates to about 70 million. So the S&P 500 had a return of about 70%, while the algorithmic trading had a return about 121%. In terms of risk management and compliance, so the assets are allocated as follows: 39% in equities, 18% in mutual funds, 17% in bonds, and 26% in ETFs. So diversification is used to smooth out unsystematic risk in the portfolio. Also, many of the assets in the portfolio are traded in American dollars. So to minimize the exchange rate risk, currency swaps are used. The fund is situated in Ireland, and so is regulated by the Central Bank of Ireland. It's also in compliance with the UCIT, which ensures that the fund is exempt from individual EU countries' national regulations. So I'll pass on to Rob now for the conclusion.
Back here. So I just want to say thanks to all of my colleagues for speaking here for our part, and then thanks to everyone for listening and paying attention. If any have any questions, feel free to contact us. Our details are shown here on the screen. Thank you very much.